Good morning, everybody. Welcome to the most important day since the last most important day, yesterday. It's Fed Day. Morning, Kay. Morning, Steph.
Morning, Ryan. Good morning,
Coming in, I see him sneaking in the back door, late as always. Hope you got a note, mate.
Hello. Sorry, I'm late. A note from the parent.
The old dog ate your homework again, did it?
Yeah, you know it. How are you guys doing? You ready for today?
Ready to rock and roll. We are ready to rock and roll.
Yeah.
For the semi-final between France and Morocco, right?
Of course. What else? I think Argentina-France is going to be a real nice final. I think it will be good. If France win, obviously.
I don't care about football anymore.
or Harry Kane.
Yeah, or Harry Kane. Yeah, I want to get back to the domestic game. But, yeah, there'll be another good. It should be a good game. It'd be funny if Morocco get through. It'd be hilarious to a World Cup final. But anyway, what we're going to watch? The Fed or the World Cup game? I don't know. It's a tough call.
We watch the Fed for about 5 minutes, then we go to football.
Yeah, it's an old two-screen job. Okay, let's get stuck into it then, because obviously lots going on, and as usual, the tides are coming and going. We've had the CPI report obviously yesterday. We'll take a quick look at that just to go over the numbers, just so anyone who has been living under a rock or was not at their desks yesterday. So the CPI came in weaker than expected on all measures. CPI 7.1% versus 7.3 expected, 6% in the core versus 6.1% expected. So definite trend lower in inflation and picking up speed more than what the market expected. And obviously we've seen the requisite moves on that. Dollar yen, as you can see there, took an absolute hammering. Bit of a dead cat bounce this morning. It's taken another knock on some BOJ news, which we'll cover in a moment. But weakness is now ingrained in the dollar further after the CPI numbers. And what that's done is it's changed around repricing. Everyone's now repricing bits and pieces, terminal rate for Fed hikes. All the banks are changing their forecasts, and the different market elements and assets are changing. If we look at straight after the CPI report, futures implied that traders see a growing chance of a 25 pip hike in February after 50 pips in December. So scaling down expectations for rate hikes. In the swaps market, they priced 100 basis points of additional hikes by March versus 110 basis points prior. The Fed swaps saw a lower December 2023 policy rate by about 20 basis points, and the Fed swaps peak rate came down to 4.88% for May 2023. So a lot of repricing going on. All the pivoters getting some ammo for their calls of when rates may top and then start coming down again, and it's all squeezing into 2023. What that's done really for the Fed today is it's made it tougher for them to get a big reaction over being hawkish. If they are hawkish, we're going to expect dollar yields to rise, but that's going to be the path of most resistance, more so than it was before the CPI data. But we'll get into all that once we've gone through the rest of the bits and bobs today. So as ever, we look at China. Again, COVID cases rapidly rising over there. Apparently, it's sounding like it might be a bit of a wave coming across China in terms of cases. I've got worries about that over activity. You know, if factories lose tons of workers and so on and so forth. But on the flip side, you know, if people are only catching it for 7 days and they're going to play catch up with the rest of the world, you get it, you get over it, and you get on with life. So it could just be a bit of short-term noise that we get maybe for a few weeks, a few months, while COVID swoops across, does its thing, everyone recovers at the end, and then we start getting back to normal. But that still may impact activity in the short term. The VP Sun, Vice Premier Sun, said that China should shift COVID focus to treatment from prevention. So echoing that that they're going to allow COVID to sweep across. On the monetary policy front, they're likely to keep the medium-term rate unchanged, the MPR, which is one of the rates they could cut. Like to keep that unchanged now after we got that RRR cut. And yesterday we thought that they might postpone this big economic meeting they were having tomorrow. Apparently not. They're not going to postpone it. That's back on. So we could get some comments out of China tomorrow or Friday about their next path for fiscal policy and economic policy from China. But they've apparently also asked banks to prop up the bond market via prop desks, because there's been a bit of a slump in the bond market, a few issues there with some big redemptions. So the PBOC have asked banks to step in and add a bit of stability there to bond markets. Coming over to Japan, there was an analyst piece out from BNP Paribas that the BOJ should amend their policy statement to include scope for rate changes. Now, it caught me because the person, the lady who's the chief strategist at BNP who put this piece out, is said to be a potential candidate for the role of deputy governor, one of the deputy governor seats at the Bank of Japan next year. So it may be worth keeping an eye on what this lady has to say if she does end up in the hot seat. So normally we take bank analysts and the stuff they throw out with a bit of a pinch of salt, but this may be something worth keeping an eye on. Now we've had this call again about the framework stuff, and we've had this secondary move in dollar yen that you can see on the screen there just a few moments ago, or about 20 minutes ago. This was a piece from Bloomberg that's been hitting the wires, that they're expected to conduct a policy review. Now it looks one of these typical Bloomberg spin headlines, because they had this piece out early on this morning or late last night. Gavin, who's in the chat here, he's in our room. He put that piece out about 6:20 this morning, and it's really economists who have been asked, what they think the BOJ should do, and they're all pretty much in agreement that they should change or look to change their framework. But this got spun again, as I say, about 15-20 minutes ago, and it's caused a big knock down in dollar yen to a fresh low for the last few days. So the power of a headline again, and we're seeing lots of sources stuff being touted around this morning, some from the ECB, which I'll move on to in a moment. That Bank of Japan stuff, Kay, it's funny how you see it work in the market. I mean, I ignored it. I heard it come out on the squawk, and I ignored it because I thought, well, we had that this morning, and I didn't realise dollar yen had moved.
Well, we had it for days, if not weeks already. That people were commenting, and I don't recall. Was it on the Flow Show yesterday that I said, in any case, it's been 10 years since the new monetary policy, since the last review, and then in the meantime we had 10 years of stability at the Bank of Japan as well, with Kuroda at the helm, and now he's leaving at the end of March. So you have two events which are going to spur the review anyway. But of course, in today's markets, with inflation rising in Japan finally after I don't know how many centuries, and Kuroda leaving, the market is of course speculating on the fact of a bigger review. We already heard from some side, and I don't recall exactly who it was, at the Japanese government or the Ministry of Finance, saying that the new policy may look very much like the old one, but there could be some sort of relaxation coming up as to the fixed 2% inflation target, but that also has already been discussed for quite a while. So I'm not sure how this review would look. On the other hand, regarding the the candidates. I recall when I was, it was my old employer, this one. We already had our chief strategist, having been nominated 2 or 3 times to fulfill a role at the Bank of Japan as one of the BOJ well, core members, but that hadn't materialized. So I don't know whether Nakazawa-san is having more chance to get there, perhaps because she is a woman and there is some talks at the Bank of Japan that they are not diversified enough. She might have a chance to get there, which will be interesting, of course, because she's talking about tweaks and things to a possible monetary policy. Yeah, we can't ignore it, right? And the fact that dollar yen gets a knock on the head, it's a bit in line with the latest events, right? Dollar getting sold, Japan higher inflation, as I already said, and yeah, and
it seems another no smoke without fire type situation, doesn't it?
This kind of thing also. Japan, and we know, and we've discussed that here as well, is that the window for them changing something may be rapidly changing, rapidly closing. On the other hand, we saw this calculation article yesterday, which said that if they would change anything, it would cost the Japanese investors about $1.1 trillion. So it's all still to be taken with the necessary caution, I'd say, this whole policy review thing. But it could be a massive sell the rumor by the fact. Go and have a look at the 130 or even below dollar yen, and then they don't change anything. And next year we trade fresh highs. But that's, of course, too early to tell.
Yeah. Moving on to the old defense spending thing they want to do. It's taken a new turn because now perhaps they might tap their Forex reserves, special account for 3.1 trillion yen to put in this defense spending pot. So they're trying to, next, I think they'll be looking down the back of the sofa for change for this defensive thing, but that's the next line that's apparently being looked at. Over to the RBNZ, they had a bit of a review, I think the annual review, and the consensus was that actual and expected inflation is still too high and needs to be reduced. RBNZ's Hawksby came out and said we have more work to do to curb inflation and seen very little impact of high rates so far, and that the neutral interest rates have drifted higher. So that keeps them on the hawkish side of the street and potentially on their current hike path. Over to the Bank of England. Now we had some financial stability stuff out yesterday, financial stability review, and BOE members were speaking on it. So if you saw some comments talking about inflation and stuff like that, it's not to do with monetary policy because they're in the blackout period with the meeting tomorrow, but they were speaking on various things. And BOE Woods said that it's appropriate for banks to tighten lending conditions for higher risk lenders, and Bailey was out saying that the UK faces the risk of second round inflation effects, but no, that's no sort of hint for tomorrow. And speaking of the Bank of England, also CPI data out this morning there too, and CPI coming off as well, although I wouldn't call it a huge reversal. Core CPI there down to 6.3%, so a little lower than expected. Was expected unchanged at 6.5%. CPI down a bit more than expected, 10.7% versus 10.9% prior. Expected, and 11.1% prior. So 4 pips down on inflation there, but still well above 10%. The UK has a long way to go, I think, before we can start calling peak inflation over here. There's still big strikes going on, big pay increases going through as a result of those strikes. We've still got big energy price issues going on. Another round of price hikes coming in January, even with the caps and stuff that are going on. So, we may be seeing inflation pulling back a tiny bit and more so elsewhere. I don't think it's going to be coming down as fast as in the UK, and that's potentially going to be the consideration for the Bank of England tomorrow. But we shall see what they have to say about things. Some of the other numbers there, PPI, RPI, all looking still quite frothy, if you like, and grocery inflation actually rose within those numbers. So prices in the shop still staying high for food and things like that. So yeah, I can't see inflation coming down significantly in the UK just yet. Over to Germany, and Germany's IFO were out with their latest forecasts, and they think a recession will be milder than expected. They modestly saw 2023 growth not as crappy as they did last time, only down 0.1% versus down 0.3% prior. Yeah, so they don't see things as bad. We'll wait and see on that front. Now, more sources, and the usual ECB sources this time, and apparently the new ECB projections are going to put inflation comfortably above 2% in 2024 and just above it in 2025. That may not sound significant, but the ECB's target is inflation under but close to 2%. So if their projections are set to go above 2% and stay there for a while, that's going to be reflected in ECB policy. I still think there's a small risk of a 75 pip hike tomorrow, although the market is pricing 80% chance of it being 50 basis points. So I think it's a bit of an open question tomorrow for the ECB, but we can deal with that tomorrow. And just coming back to the US, Biden was talking about the inflation data and said it's coming down, things are heading in the right direction, but there's still more work to be done. And funny enough, there's been a bit of commentary over the data yesterday because there were some moves apparently well before or in the minute leading up to the actual release. Let's have a look at that there. Where am I looking at? Is that the wrong time of day? No, where am I? There we go. So some moves being seen just before the data, apparently in a lot of assets, bonds, stocks, you name it, the dollar. There was a bit of a move before the data came out, and the White House or the Labour Department was out saying that they're not aware of any early data release, but leaks have been a plague to particularly the UK in the past, and a bit strange to see some moves there. So we'll keep an eye on things like that moving forward. Did you see anything? I know we were on the FACE show yesterday and getting ready for the data and that. Did you see anything funky going on, guys?
Oh yeah.
Yeah, I mean, price section was suggesting somebody knew something. I actually said, oh, somebody knows something. But clearly somebody did.
Yeah.
Yeah.
Go on, Kay.
Yeah, definitely. I mean, the half hour or so before, even the half hour before, it was already going, and then those. You see the dollars, but then have a look at what happened on the S&P just before. I mean, it was clear there's something.
Let's see if we can have a look at that. Yeah, so there we go. So right in there, 27 on the 27 minute, on the 28 minute. Yeah, big spike there, and we didn't even get that high when the numbers came out. So yeah, quite something going on there. They'll keep an eye on that because they don't take lightly to that sort of stuff in the US. So we'll see if the SEC throw some stuff out. Right, so to the Fed today, because that's going to be the big show in town. It's what we've been waiting for all week. And as I mentioned, what the CPI has done yesterday is it's made it very difficult for the Fed to get any big hawkish message across. They could say rates are going to 6%. They could say they're going to 7% as a ceiling. The market isn't going to believe them because now they've seen the data. So whereas previously a hawkish, or before the data, a hawkish Fed might have seen yields rise significantly, the dollar rise significantly, I think anything like that is going to be short-lived. I'll be very surprised if we see any form of big move higher on hawkish news, and that sort of stuff is going to get sold into pretty fast. That's pretty much my general thoughts for the Fed. I'm still going to be looking to sell any big rally in the dollar if we get it. I did try a bit of a knife catch in dollar yen over the CPI report because I thought it had gone a bit too far. I bought as we dipped down here, managed to get some away, but then got stopped on the rest as we broke down to those lows there. I am still short a very small bit of dollar yen for my long-term pot up above 136s, so I'm happy to keep that in my pot. But I was hoping maybe to get something up, 139s, high 138s, 139s, but it isn't to be. So this might be ended up being a bit of a chase trade to get something on to build up a bit of a longer term position. On the other side, my Aussie dollar is doing okay. We had a big break up, chewed through levels, got above 68, got above 68.50, got above the fib. Ran into a brick wall into 69, which we know is where the next round of resistance is coming in. I was looking for the levels to hold on the way down. They didn't. So we've decided that 68.20 is where we're going to pull up ahead of the 68 level. That's been the support point from here. It's really going to be about what happens at the Fed now. If they do manage to get a hawkish message across, this could go back in the box, back under 68, and then we've got all the hard work to do. Conversely, the market might be pausing here if it gets confirmation that the Fed isn't overly hawkish or is going to stick to the same path it has been over the last few weeks and since the last FOMC. We could be on for another shift up, and I'll be looking for 69 and that 69.15. 17 area to break that fib, that 38.2 fib there. That's what I'm looking to go next. And then we're probably on for the 70 level. So I'm positioned okay. I've got good margin in this trade. I'm happy to sit back and ride it as far as it will go. And we'll see how that goes tonight. Guys, you looking at anything particular, and has anything from the CPI changed your thoughts for the Fed today?
For me, a little bit. This miss in the CPI makes me a little bit more skeptical. I still think that the risk is for the Fed to disappoint the bulls, because once again, let's remember what the market's pricing. A 50 is done for today, and then 50 more, or actually slightly less now than 50, and we're done. So what is the risk? I think the risk is for Jay Powell to hint that the peak of rates is going to be higher than that, and will probably stay higher for a little bit longer. So I think the risk is for a hawkish surprise, which means risk off, dollar spike, yield spike. We talked about it so many times. But I have to admit, yesterday's number weaker than expected. I've always said I think inflation is going to start dropping a lot in the end of first quarter of 2023. It's already starting to do so. And look at the UK as well. It's surprised on the low side. Look at Norway, inflation also on the low side. Yes, they are more affected by oil. So the drop in oil has affected them more, but still the trend is there. So the Fed does have the excuse if they want to be dovish. That's what worries me a little bit. I still think that the risk, though, and the bigger reaction, market reaction, is going to be on a non-dovish Powell rather than a dovish one. So I still think that's the risk. I think inflation is going to start dropping very quickly. First quarter 2023, late first quarter. But and I do, you said, Ryan, earlier, you said, I think inflation is going to be sticky for the UK, right? You said inflation is going to stay high. I think I would actually say prices are going to stay high, not inflation. I think the inflation rate year on year is going to drop, but prices are going to be sticky. Just the rate of change is going to drop substantially. Is that good? Of course not. We're baking in all this price increase now, but theoretically we should be seeing negative inflation for us to go back to normal. I don't think we're going to see negative inflation, or if we do, it's going to be very temporary. But that I think is the risk for today. For a few months from now, it's a completely different story. But for today, this is what I think. And yesterday's number has made me a little bit less certain of it. I would have loved to see a CPI in line with expectations. I think if we had got that, Powell would have been a lot more confident in being a bit less dovish than the market's expecting. But now I'm not so sure. That's my issue. I don't know what Kay thinks, but that's my opinion.
Thanks, mate. And let's find out what Kay thinks.
Well, I mean, to pick up on what you said, they might have an excuse to be a little less hawkish due to the CPI. On the other side, Powell and his mates have the excuse to be hawkish because the assets are doing absolutely great, and the yields have come off. So it's really a double-edged sword for me. The thing is, unless there is a surprise somewhere in what they will say, so to me there's like three things really. They will be looking at inflation, of course, but then there's the job market still holding up, financial conditions having eased. It's going to be, is Powell going to walk a fine line? It's a bit of an open question right now for me. Although I think there is very little reason to be dovish. You're still looking at 6% inflation core. You're still looking above 7% on the headline. The market wants to sell dollars, and it has been selling actually quite aggressively so since November. So are we? Is it going to change much tonight? That is my big question. So I'm really hesitant on this one. Although in my view they should not be dovish. There's not too many reasons to be dovish because the big last domino, the job market, is holding on, and perhaps he will say something about financial conditions. Will it change much? If you look at how the market is trading this, we had this jump on the PPI. It's very jumpy, but at the end, after the CPI, we are at the lowest levels in dollars for a while. So is it going to change much? Are we already starting to see year-end flows? It's a bit of a mixed picture in my mind, but I've spoken about that in the chat room. I'm going to really see what the other side of the dollar pairs are doing. Thinking about dollar yen seems really very heavy. Euro very big. It's really what's going to happen on the other side of the dollar as well. Personally, I think it's we are give and take 0.5% or 1% or whatever. I think the dollar correction will be enough soon. But is the market going to tell me the same thing? I'm not 100% sure at this stage. If the CPI would have been more in line, I would have said I would have been much more confident in buying dollar dips. But at this stage, I don't know. We could have Powell saying very little and still the market reacting a lot to it. If he doesn't fight back against what he said at Brookings the other day, why not? It could get another knock on the head, this dollar,
Yeah, and it's important because we look at this and we constantly repeat on the show. It's all about which way the market is sitting immediately before the event, so immediately before tonight, and this has changed since Brookings, since the PPI, since the CPI. So we have to look at where we are now. I was the same as Kay and Stell. If CPI had come in line, then yes, I think a hawkish Powell would have had a bigger reaction. Now I don't think he's going to have as big a reaction because the market is saying, don't care what you say, we're seeing inflation dropping quite significantly. So we're going to ignore the hawkishness that you delve out. But then on the flip side, what we try to do here on the Flow Show is put a bit more fundamental analysis into things. And, we look at the data all the time, each week, each day, each month. We comment about it each day. So how does that filter into tonight? Well, you take the CPI, you take all the data that we've seen so far, and you've got to say, everyone's expecting the US to head towards a recession. Powell's spoken about it. He doesn't want to destroy the economy and then pick up the pieces after. He'd rather get a soft landing. And you've got to say, when you see, the PMIs and the ISMs all coming off significantly, bar the services part, you've got to think, well, that's the negative side of the economy. But on the positive side, consumers still spending and there's still strong jobs growth. Now, that was different when inflation was rising. It's now different again. Now inflation's falling because the Fed are potentially achieving what they're setting out to do, which is bring inflation down. The evidence is there. Meanwhile, the economy isn't yet cratering. I still think there's a risk that we haven't seen the full effects of all the previous hikes over the last few months. That may start to show up in the early part of next year. But sitting here right now with this Fed meeting tonight, you've got to say from weighing up all the fundamentals that a soft landing is still very much on the cards. And if that happens, you've got to think, okay, they may not get as high on rates, but are they going to be forced to cut them as soon? Because if the economy does have a soft landing, there's a chance it heats up again. They're going to need to keep rate hikes in place to cool that softness, to cool that heating up. And if they do that, looking at from an FX point of view, what currency is going to be the most strongest? If you've got Germany and Europe going into recession, the UK going into recession, others going into recessions, but the US doesn't, where's the flows going to go to? The flows are going to go back into the US, but the whole picture is going to change. Risk on is going to be buying US stocks and buying US dollar, because that's where investors are going to want to park their money, because they've got high yields, high rates, high growth compared to all the other countries. And all these things are going in the pot for tonight's FOMC. Where is the economy at? Is it hard landing or soft landing? At the moment, it's soft landing, and that's going to keep them on the bullish side for the economy, as well as potentially on the hawkish side. But we've got to fight what the market's going to need to do with it, and that's the big kicker. So, looking at some of the other assets, Rich is asking about DAX. You're playing it on the short side here. Now he's trading in the range. Well, again, you've got to come back to, we've seen what the moves are here. Anything that's risk off, stocks up. But are we going to see a bit of a divergence coming in? If they're bullish, if the Fed is bullish about the economy and Europe and the rest are heading into recession, do we start to see a divergence coming? Do we start to see stocks falling based on what economies are doing, rather than central banks turn into more dovish? I think that's going to be the key thing. Kay's mentioned it with the yen and stocks. Maybe that's going to get back to being correlated. So there's lots of moving parts here. Hopefully we get a few answers tonight, but I'm not so sure we do. Still, what do you make of it in things like stocks? Are they going to start reflecting the fundamentals in 2023, or is it going to be just what monetary policy, whether it's dovish or hawkish?
Good question. The whole market is not. I was watching a video. I can't remember who it was, and he was saying that the markets no longer care about earnings. Stock markets. Earnings and fundamentals and this. All they care about is, are we going to have more easy money from the Fed? And unfortunately, in a big, big way, that is true. And at least in the short term, this is what the stock markets are looking at. Fundamentals say that the market's still a bit rich, and with yields rising as they have been, and with layoffs coming, and with earnings starting to disappoint, we should have lower valuations. Look at PE multiples and forward PE multiples, I mean, they are at very elevated levels. Fundamentally, we should be correcting lower. But if we do get Powell being dovish or showing in any way that rates are going to be peaking very soon and even dropping, then the market reaction is going to overwhelm everything else and probably keep going higher. That's the unfortunate reality that we're faced with. So I think that's the key driver at the moment.
Yeah, I think you're right. I think if you're trading stocks and you've been trading it on the current risk on, risk off basis, you stick with that for today. You know, that's something that you may see changing coming into the new year, but for today and running out the year, that's how you trade it, the same as what you have been previously.
Yeah,
go on, mate.
If you just look at the, because a lot of people are trading DAX in our community. If you look at the, so Richard, if you're not yet in our community, I'd say join the community, because there's quite a few people looking at the DAX. The levels that people, oh, there you go. The levels that people are looking at really is 14,200, and the big level on the top side seems to be the point of no return, and I think Greg has spoke about that as well. Is around, and I was looking at that as well. Is 14,800 on the top. So I know it's a bit wide. It's what? It's like 600 points. It's about 5% wide, but then stocks can move that much. So those are the bigger levels to look at. And then in intraday. I must say that every time I look at the DAX, it's around these 14,300, 14,400. So there seems to be some decent traffic around this zone as well. So that about the DAX. And about stock valuations, I tend to agree with all right, okay, yeah, the 14,200 is pretty big. And I agree with Stel that the valuations are still high, and I mostly agree with what he said about people don't give a toss about earnings for more than hours, or let's say a day or two, to pay attention to the company that just brought out the earnings, and then afterwards on the indices we don't find it, we don't find those this earnings impact back. So we have to know that those things seem to have only a very short-term impact right now, the earnings. But if you want to do a good trade on the valuations, and that's a joke, I'm saying it on beforehand. Buy Credit Suisse, sell UBS. Credit Suisse is priced at 20% of UBS's valuation, but that was a joke.
Yeah, good luck making the market in that one, mate. They have quotes wide enough to drive a bus through.
Now that they have brought back Credit Suisse First Boston into life, we can expect a few more accidents down the road there.
Yeah, definitely. Good time to be a lawyer. Right, so let's look at some of the pricings going into tonight's Fed. Because, you know, for all the talking we can do, it's really about where markets can go, where the dollar can go. Actually, probably should be better off starting with yields, because I think that, as usual, going to be the big driver. And, you know, we've been watching the 2-year yield for as a rough guide on where the Fed ceiling is being priced. Now, it's had a bit of a breakdown. You know, we're under this 4.25% mark. We've been ranging, you know, up, 4 3/4, 4.5, that sort of area. It's given us a rough pricing guide to where the market sees the ceiling coming in. And obviously, one of the important parts of tonight will be the new projections and where the dots are sitting. How high is that ceiling going to go as far as the Fed is concerned? But the market is bringing down its expectations for how high Fed rates can get. And that's going to be a key point again tonight. You know, this has been in play since, September, October. It's come through everything. It's come through FOMCs, it's come through CPI reports, it's come through the lot. And it's only now we're starting to see a breakdown in 2 years. 10 years they had a little move as well. We saw that prior low coming in last week in yield. We couldn't get there quite on the CPI data. Again, that suggests that the market for now is pretty comfortable with where it's pricing the forward path of hikes, further out. So again, from the Fed, we need to see, is this going to become a solid bottom around 3.4%, or are we going to break it and head lower? Conversely, on the upside, what can we do? Can we get back above 3.5%, 3.6%? If we do, that's going to be a bit more positive for the dollar. Alternatively, if we come out the Fed and we're just in this box, then I suggest we're going to see a bit of sideways action going forward, and then we enter into all the year-end stuff, which is a lottery on its own. So for looking at your dollar pairs, we've seen some breaks. Dollar yen looking much weaker now. But again, can we get down to these lows over the Fed? Can we break these lows over the Fed? If we do, then that gives us a potential for heading to new ground. Maybe we're going to test back down to 130, test some of these bigger fibs that are in play coming in. We've got a whole gathering of fibs coming in down around this 133 area. Going to be a big level, at least on the technical side of things. This is what the price has got to do. So if we can't break that level, again, it suggests the market's happy where it's at. You might have a bit of conviction to maybe scale in some short-term longs in dollar yen against all this tech and this 133 down here. Maybe get a move back to 134, 135. And you can look at plenty of pairs. Look at euro dollar, banging its head at the 106. Now we're sailing pretty well above. Next big level is going to be up into the high 107s, 108s. Big, huge level coming in there. It's been a previous historical level. It was a big level on the way down. It's always been a big level around at this 108s. That's going to be your next basis for where the market can go. Can we get above it? Are we going to hold there? Is that going to mark a ceiling for prices so far? So there's plenty of levels that are in play for this one. You've got to do your homework, get stuck in your charts, find out those big levels, find out where the market's got to ask a question, what it's got to do. For me, I'm going to be doing the same thing. If we get a move up to 108, I'm going to think that's a bit of a stretch point. And maybe I'm going to be looking at shorts into that, at least for a first attempt, a first try, even if it's just a scalp trade or sit on it for a bit. I'm reluctant to jump in right as stuff gets announced because the market can tend to move quicker than I can push the buttons, but it's always good to have a look at the snipes. What are you guys looking at in particular? Are you looking to get in on something or fade something or manage what you've got?
For me, it's not as clear as it was. I think that okay, let's take the dovish scenario. If Powell is dovish, then I'm just going to keep adding to my metals longs. Probably going to add some miners as well. Just get into that trade a little bit more. If he's hawkish, then it's a bit tougher. I still think cable is not as clear now. Cable is broken. I hate cable. I wish it hadn't broken yesterday. If it's hawkish, I don't know. I think short bonds probably going to be a trade. I don't know. I know what I'm going to do on a dovish scenario. I don't know what I'm going to do yet on a hawkish one. I don't know what Kay thinks.
Okay.
All right. And I'm very small in on stuff which is outside of the majors, let's say. And I'll show the screen. Do you
want to take it now so you can show what you're talking about?
Yeah. Okay, I'll grab it. Okay, let's do just doing the round, right? You guys see my silver screen?
Yeah.
Yes, sir.
Okay. This one is not a clear cut, really not a clear cut, and we are like barring those breaks that we had and then coming back into it. We're still in which is a bit of a downsloping channel, but I think on any decent, but it may take a bit of time, on any decent reopening of China, this should break. So what and at the same time, I'm a bit reluctant on those China reopenings, and I'll show the dollar CNH afterwards. I think it's they're going to go through a mess before getting out of it. But if you look at if you're bearish dollars, and if you believe in things not going as bad as we would or we could fear, this one may be starting to look like we could be setting up for breaking higher, but we need some conditions to fall into place. So I have my long-term longs. I did scale. I had it, and I did scale back a little bit yesterday, and I'm okay to wait patiently now to see if we're going to break 24.5, 24.60 here to add. If Powell is dovish, despite what I still think fundamentals tell us that the situation is not dramatic, I think this could really take off. If he doesn't give us anything, or if he's even a bit hawkish, which I think is still a possibility, then I'm looking to reload into this 22.5 zone perhaps. That for the metals, this is something that I'm going to keep an eye out for tonight. Euro dollar, you covered it. Cable, I'm not even going to look at it because to me the Bank of England is this time, for me at least personally, the most difficult to read. So I'm going to stay away from sterling for now. Even after Powell, even if it goes up to 125, I really don't know what to do with sterling on the Bank of England. Gold in this upwards wedge, or I suppose you call it. If ever we get back down sub 18, I think 1785-ish, 80.85 is going to be a bit of a support right now. If in turn we start to break above 18.25, we could be heading for this zone like between 35 and 55. That is a possibility as well on a dovish Powell. And then, well, actually, no, I'm going to look at the euro dollar just because it's there's this in the more medium term. You know, when we spoke about this one months and months ago, we had this first attempt, 108, and then the break below, and we've never looked back since. Are we going to see this recovery up to this red line, or is 108 a possibility and then stop and go back down, or can we get a retest? It's possible because the 50% of the move down is around 109. So if ever into year end, and on a dovish Fed, we could make it up here because we have ECB as well tomorrow, and in theory, they will raise rates as much as the Fed. Start probably to talk about stopping at least the QE and see what they will do about QT next year. And then we have year end. It's all possible that we're getting up here. Then I'm going to really have a very close look at it because I think the recovery might have ran its course then. But that's probably something for a week or two, unless the market is really getting very, very dovish on the dollar and takes it up there right now. On the other side, short term for tonight, 105.80. We're about 70 pips above, so that's already a good enough, I think, marker to take a quick look at. And then back here around, if it wouldn't be enough, 105, 104.80. That should be a decent level. And I think, as we were saying, the market looks like it has made its mind up, at least in the shorter term, that the dollar is going to trade weaker, whatever happens. So take a look. If ever we make it back down there, I'd expect people to come in there and try to buy euro dollar again, even if we are below this trend line. Unless Powell really goes like, okay, financial conditions are not good enough or not tight enough. Job market is good. We are doing 50 now, and don't expect us to slow down much more than this. Then in that case, I think the dollar could really put in a bit of a performance today, at least until the next central banks tomorrow. As I said, cable, no clue. I want to look at the antipodians. If you look at this, the first thing is the one that Ryan already spoke about a couple of times, 38.2 of the 2021-2022 decline. I should have, it's here, right? The low point, but to keep my charts a bit clear, I've done it in two separate parts. 68.75. Yesterday we traded briefly above it, and now we are hanging just below. To me, there's a couple of interesting things here as well. A little bit of a rising channel, but broken above and failed. I've showed this one yesterday as well, broken above and failed for now. And then keep an eye on this line, 69 on the head is the 200-day moving average. So this whole 68.75, 69 the figure zone, and it's also 78.4 of the, that's a little bit higher, but anyway, yeah, that's just above 69. This whole 68.75, 69, 69.10 zone is going to be very important, in my opinion, for the Aussie dollar tonight. If you really start to clear it, then 70 is just a matter of perhaps even hours. If though we close tonight below this, then I would not, I wouldn't rule out that the Aussie can make it back down to 67, the figure. So keep an eye on this one. Kiwi is a little bit the same pattern now. We had this break above what the 64.5, which is also, and even the prior August high 64.65. Didn't even stop around there. We flew through, but then we stopped well below the 65.30, which was my next marker, and we started to come off again. We're around 64.40, so we're around this level. A little bit of a support here, but that's too short. Keep an eye on this Kiwi for tonight. And we've seen a couple of warnings about the New Zealand economy. The past few days and overnight, the current account went deeper into negative. So I'm a little bit in doubt. Where I was pretty bullish Kiwi for a good while, I'm starting to doubt now, and we have to be a bit careful if ever Kiwi would make it back down below 64.15.20 tonight. And my cautiousness on the Kiwi is now expressed back into Aussie Kiwi, and as people know, I was long around these zones. Let it go because it didn't want to take this. But then yesterday I started to buy back, and today we're now through this 106.20.30 resistance. We need to pay attention to this more medium-term trend line around 106.60. We just touched it this morning, so this could be a first hurdle. But I'm starting to be a little cautious on the Kiwi. So, and since I think that the RBA, RBNZ divergence has been traded enough now, this is one firmly on my radar. It could possibly start to push a bit higher again. And really that's about it. My China doubt is expressed through dollar China. I think for as long as 690-ish hold, I'm really doubtful that the reopenings are going to be as swift as what the market wants to trade it right now. Of course, there's a dollar side, so I'll keep a close eye on what's happening around 89.91 in dollar China. But anyway, we saw a retest of the 7 yesterday, capped, and we are back lower. So for the time being, trade the range, I'd say, and then keep an eye on 690, 688. I'm trading it from the catching small knives sites, and really that's it for me, Ryan.
No, thank you very much, mate. Mark's asking, can we have a look at the gold-silver ratio? I haven't got that on my chart. That's one of Dale's specialities. So maybe we'll come and join us on the Face show, and we can have potentially have a look at the gold-silver ratio there. Gavin, Kiwi yen looks like it's failed up at 88. Just looking at that quickly.
Oh, I was just on it.
Okay. Oh, sorry, mate.
No, you're grabbing.
I've got any text on it. I'm just looking at the thing. Do you want to take it?
No, well,
Yeah.
Let me grab it. Okay, this one, the ultimo level to me is still closer to 90. That's more the medium term, which is this one. But yeah, there is a possibility that in the short term we are in for a bit of disappointment here, especially with the yen acting like it is. 86.80. Where is that? Where is Kiwi yen actually trading right now? Oh, it's we're actually right on it. So I'd keep an eye on this 86.80. Where is the last? And then below there, 86.5-ish. But yes, and also in line with Aussie yen. Aussie yen is also having trouble, right? Yeah, the fact that we are back below the prior high should be keeping us erring on the cautious side there. Yeah, and keep an eye on this 86.80. I would say an 86.5 below there. That should be an interesting little zone here. Dollar yen in turn is
just before you flip to that. What I think about that Kiwi yen is that maybe the egg's been cracked at 88. I know it's come over news and data and whatever, but the fact we have made that newer high through 88 potentially means that if we get another run up there, it's not going to hold maybe as strongly as it was previously.
No, that's true.
So it could be a bit of a flyer if
yeah, that's true, because beyond there, I don't see much. In fact, before this bigger trend line, and which would coincide with prior highs as well. Yeah, look, this Aussie yen is really in this triangle, and we are about to get out of it right in how do you call it, in the point. I'm not sure, but if you look at the trend line, it's been banging its head against it, and it's failing each time as well. So keep an eye on that one, which side we are going to get out of this triangle. Yeah, really, dollar yen is weak, right? It can't hold retracements. It did cap very nicely around 137.90 figure. It's not really sexy. There is support around 134.5. So that is one that is to be respected. But on the power, man, if we already make it back to 135, call it 65.80, or already pay attention to what's happening there tonight. We really need to break back above this. Yeah, it is 135.80, 85 to get a move back higher. And then don't forget next week Bank of Japan as well, which also will have a word to say about this one. Yeah, so that's it for me right now. Back over to you. Oh, and I'm looking at the time. I think we're about there. We don't hear you, Ryan.
Hello, you got me?
Oh, yeah.
Got you, yeah.
there.
Yeah,
Thank
sorry,
you.
someone wants to have a quick look at oil. So just a quick view. This to me is looking a bit dead cattish, this bounce. I'll be worried. You know, we take the prior lows in this area around here, 76 is 76 and a half. Maybe it's a bit of a marker here. If we can't get above that, then as I say, this is going to look a bit dead cattish. The trend is obviously pretty much entrenched, lower inflation, coming from lower oil. So that's a big part of things as well that we've got to keep an eye on. If that stays subdued, oil prices, that's going to help the inflation picture as well. But trading wise, you know, Dow pretty much nailed the bottom of this one, down to $70. As I say, if we get above here, maybe we've got to push up to 80. But I'm not sure we're going to start seeing this rally all the way back to 90s anytime soon. But again, come on to the Face show later. I'm sure one of the guys will pick up the oil baton in a bit more detail. And so, yeah, that brings us to the end of the show. Everything we've done so far has led us up to the FOMC tonight. So I hope we've given you enough preparation for that. If you haven't, then obviously do join us in the chat room as well. Ask any questions you want, any further information you want, you can come and do that. And all that's left is to wish you a safe trading through the Fed tonight. If in doubt, stay out. Pick up the pieces after. Thank you to Stel, thank you to Kay, and we'll see where things stand tomorrow morning. Have a good one as always. Cheers, guys.
Thanks, everybody.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.